Okay. Good morning, friends. We'll continue with introduction to capital budgeting. So in the last class, I had introduced on the 6 techniques of capital budgeting, and we have solved few problems on that. Today, let's complete the pending problem which is there in the introduction, which is modified NPV and modified IRR. Go through question number 6. Okay, now coming to this question, as such, there is one concept which is called as NPV versus IRR conflict. You would have learned this at IPCC level also. Now, please listen for some time. NPV as a concept says that whatever they receive in between, they will get reinvested at some cost of capital, whereas IRR as a concept says whatever you get in between will get reinvested at the IRR rate itself. Now, what does this mean is, for example, if there's a project with 100 rupees of outflow on day 0 and you receive 40 rupees, 50 rupees, 60 rupees in between, IRR for this cash flow is 22%. Now what does IRR assume is that the moment I receive 40, I can invest in some other project which can give me a return of 22%. So IRR always assumes that whatever your intermediate cash flows are there, they will get reinvested at the cost of capital. NPV says that no, it will not get reinvested at cost of capital, it will get reinvested at the cost of capital of the company. So that is what we are going to see here. Because of this reason, there you will see that there is always a conflict between NPV and IRR. So let's try to do that. First thing they asked, calculate the NPV and IRR of both the projects. Calculation of NPV and IRR of project X. Calculation of NPV and IRR of project X. NPV and IRR of project X. Four columns. Year, cash flow. You will have space for another 4 columns because for IRR you will need 2 more iteration. Year, cash flow, PVF at what rate? 10%. Year, cash flow, PVF at 10% and DCF. Year, cash flow, PVF at 10% and DCF. Capture whatever is there in the question. Do the NPV calculation at 10%. Done with this. Now, can you quickly tell me what is ARR on average investment for this? ARR on average investment. Add all the cash flows, deduct the original, that is the total profit. All cash flows total, normal total, minus the initial investment is the total profit of the project. Is the total profit of the project. Divide that by 4 and then divide that by 55. Why divide by 4? That will give you the average PAT. So the total profit is going to be 81. 81 total averages 20.25 and my ARR is 20.25 on 55. 20.25 on 55. ARR on average investment. Average profit is 20.25. Average PAT. And ARR on average investment is 36.82. So somewhere the answer according to this theory is going to be closer to 24%. So let's try it maybe 20% and then we'll again increase the rate. PVF for 10 has given a huge positive. Let's do PVF for 20 and then increase the rate. Answer will be more or less closer to 24 is the sense. So try it 20%. Try at 20%. How much? This is positive, then try 25%. 25 and then we'll get a negative surely and then we can get the IRR. Try at 25%. 31. This. No, is this total incorrect, you're saying?
No, the DC of the multiplication.
Okay. The exact answer is 22.61. We are getting 22.71. Okay, broadly we are there. If you had not done that 2/3 wala part, maybe we would have increased by 5%, 5%. So that at least gives us a more or less a closer answer. So that formula would have given an answer of 24%, and the final answer turned out to be 22.71. Now we will have to repeat the same thing for project Y. First let's calculate NPV and then we'll increase or decrease the rate. Let's do it for project Y. No, try 20 itself. Try 20 and then we'll see. Try 20 and then we'll see what happens there. So then try 25. Not sure whether 25 also will work. Try 25. Try 25 and then I'll see what is to be done. Positive. So you'll have to try 30 then. So that's what will happen in some of the times. I'll explain why that ARR on average investment is not working out also in this question. Some things which you can look at in an exam problem. Try 30%, you will have to recreate this again. This is the problem which you'll always face with IRR. Try at 30%. Try at 30% and you will get the answer to the IRR. Sorry. %25.71% is the IRR. IRR will always have this challenge. Can I proceed? Now, calculate the NPV and IRR of both the projects. Do you see any conflict in ranking? Conflict in ranking is which has better IRR? No, why no? IRR. Why? NPV X. So this is called as a conflict in ranking. Now whenever there is a conflict in ranking, what we end up doing is we try to resolve it through a modified NPV and a modified IRR approach if the life is same, and if the life is going to be different, then we do it through a EAC approach. So EAC, EAB, you will learn it in some time. Now let's go ahead and calculate modified NPV and modified IRR. Next, calculation of modified NPV. Calculation of modified NPV. Okay, modified NPV and IRR of project X. modified NPV and IRR of project X. Now to do this modified NPV and IRR, normal assumption is all cash inflows will get reinvested at cost of capital. Whatever I am getting in between will get reinvested at cost of capital unless the question provide otherwise. In this question they have said you can take two reinvestment rates. What are the reinvestment rates they have said? So I am first doing 14, assuming reinvestment at 14%, assuming reinvestment at 14%. Listen for some time now. Here cash flow reinvestment period. Now here is 0, 1, 2, 3, 4. The cash flows which I get is 110, 31, 40, 50 and 70. These are the cash flows which are given in the question. Now what does this technique say is that whatever you receive will get reinvested. Now what I spend in year 0 is an outflow, so let's ignore about a reinvestment there. What I am getting in year 1 will get reinvested for a period of 3 years. Will get reinvested for a period of 3 years. I'll create a 3-year FD or I'll put it in a 3-year project. Year 2 will get reinvested for a period of 2 years, 1 year and 0 years. For this there is something called as future value factor at 14%. Future value factor at 14%. Future value factor at 14%. Now please listen. This is not applicable. The future value factor is 1.14 into 1.14 into 1.14. 3 years. This is 1.14 into 1.14. 2 years reinvestment, 1 year reinvestment and 0 year reinvestment. Basically what they are saying is you are not going to get the project cash flows as and when it happens. You will keep reinvesting this. Maturity cash flow. Maturity cash flow is what amount I am going to receive in the maturity. So this is my initial, okay, let me ignore this for the maturity purpose. So instead of me receiving 31, 40, 50 and 70, I am going to receive a single amount called as 224. Instead of receiving 31, 40, 50 and 70, we will end up receiving a single amount called as 224.91. So the project cash flows, just a minute. The cash flows of the project is not 31, 40, 50 and 70. The cash flows of the project is going to be year 0, 110 investment, year 4, 224 maturity. Year 0, 110 investment, year 4, 224 maturity. Nothing else is there in the question. Now this is calculated. Now please listen. Cash flows, again I am writing. Year 0 is 110. Nothing. You don't receive anything, you don't receive anything, you don't receive anything, and you receive 224.91. This is the cash flow. Original cash flow which have been given in the question is altered like this. PVF at, what is the discount rate they have said in the question? 10%. So that remains same. 1. And DCF. Instead of working with the cash flows which they have given, we have altered the cash flows and got new cash flows for our purpose, and this is called as modified NPV. 43.62 is called as modified NPV. For want of time, I am going to calculate IRR directly here. IRR is 19.58. Otherwise you will have to do one lower. We have got a positive NPV, will increase the rate. So in short, the problem is same. Modified NPV and IRR is nothing different. When we did your part 1 of the question, you took 110, 31, 40, 50 and 70. Instead of taking 110, 31, 40, 50 and 70, take 110, 0, 0, 0 and 224. That's all. The question's cash flow alone undergoes a change. So how do they undergo a change? You assume reinvestment. Now this is at 14%, you will have to do the next rate. Complete this. Then I'll tell you, I'll quickly do it in the Excel sheet and you can copy the answers of the balance part. So do this part alone for your understanding. Complete this, then I'll give you the answers for the balance part. Complete the 14% reinvestment part, then I'll give you the answers for the balance parts. Once you're done with this, let me know. Balance parts, I'll give you the answer, you copy it and then I'll explain the concept. Important is learning the concept. How to calculate is exactly going to remain the same even if I do the next one. You've understood the 14% part. I'll explain the balance concept and you can note down the solution. Done with this project? Any doubts? Can we proceed? Okay, now listen, you can note down the solutions. Any doubts in this? Now this was project X. If I do the same thing for project Y at 14%, same thing, this is for project Y at 14%, IRR is 19.58, 19.29. NPV is 43, 42. So in both the cases, project X is the best. In both the cases. So below that you can write NPV of project Y, NPV of project Y with 14% reinvestment rate. NPV of project Y with 14% reinvestment rate. NPV of project Y with 14% reinvestment rate equal to 42.16. NPV of project Y with 14% reinvestment rate equal to 42.16. IRR of project Y with 14% reinvestment rate equal to 19.29%. IRR of project Y with 14% reinvestment rate 19.29%. So in both the cases, project X is going to be preferred, be it NPV, be it IRR. The conflict is kind of resolved there. NPV and IRR are both are going to prefer project X. Any doubts on this? Now I'll give the answer to the other part also. Listen for a minute. The other part says reinvestment will happen at what rate? 20%. So listen for a minute. FVF at 20%. My future value factor will be at 20%. So 1.20 into 1.20 into 1.20. These are my future cash flows, and NPV will be 54, IRR will be 21.68. Wait for a minute. This is for project X. And these are project Y. In both the cases, IRR or NPV, project Y is preferred when it's a 20% reinvestment rate. So basic thing is your reinvestment rate can change the answer. NPV as a concept says reinvestment will happen at cost of capital. IRR says it will happen at IRR. The question has given some reinvestment rate. When I do at 14%, NPV as well as IRR preferred project X. When I do at 20%, both are preferring project Y. So you can note down the answer alone. NPV with 20% reinvestment rate is this, IRR with 20% reinvestment rate is this, NPV with 20% and IRR with 20% is the other one for the other project. Project wise based. Both will prefer one of the projects. Both the techniques are going to prefer a single project rather than one technique preferring project X, second technique preferring project Y. So that issue will get sorted out. Clear? Can we proceed? Now I'll take you through the entire rules which are there for a capital budgeting scenario. So till now I've just introduced to you what is capital budgeting and the 6 techniques. The focus was on topic 1. Topic 2 we are going to focus on investment decision. Further I'll explain the rules which are there. So we had covered all of this in the last class. Meaning and importance, time value of money, project evaluation techniques is done. Now I'll talk about the principles of capital budgeting. The first principle of capital budgeting is it should be cash flows and not profits. So all the techniques of capital budgeting except ARR focus on getting cash flows rather than profits. So our objective is always to have cash flows from analysis purpose and not profits. The reason for cash flows being considered is profit is highly subjective in nature. 1 year you will follow depreciation and then SLM, second year WDV, you will write off some bad debts, you will not write off some bad debts. So these accounting issues will always make the profits change, but cash flows never undergo a change. So that is my first principle. Clear? Second principle is after tax principle. What is after tax principle is in cash flows you will have to calculate cash flows after tax and not before tax. So I will have to work with CFAT. Clear? Third will be incremental principle. Yeah, incremental principle. What is incremental principle is? Now please listen. Currently, assume you have completed your chartered accountancy and you are employed in a firm and you are getting some 7 lakhs, 8 lakhs of package. Now, you want to decide whether to do MBA or not. So, to do MBA, you will have to spend some money. So, when you decide you want to do MBA, assume you have to spend 20 lakhs on MBA for a period of 2 years. After spending on MBA, in the third year, you are expected to get salaries of some 13 lakhs. Now, when I do my capital budgeting analysis, MBA doesn't give me 13 lakhs, MBA gives me 13 minus 9. What is minus 9? If I had continued working as a chartered accountant without taking a break, I would have at least got 9 lakhs in third year. So what MBA does is extra 4 lakhs and not 13 lakhs. So whenever I do my analysis, it's always the incremental cash flow which matters and not the total cash flow. So assume you are going to do a project, that project will increase profits from 10 lakhs to 12 lakhs, cash flows is not 12, cash flows is only extra 2 lakhs. Clear? Any doubts on this? Next, rules of relevance. I had explained few of this in the last class. Now as far as rules of relevance is concerned, first is forget sunk cost. What is sunk cost is? In that example yesterday's class, feasibility study was a sunk cost because we have already incurred that cost and which cannot be recovered from my customer. So all sunk costs are irrelevant and have to be ignored. Consider side effect. Now what is side effect is? Side effect and opportunity cost are relevant. What is the difference between side effect and opportunity cost? The side effect can sometimes be positive also, whereas opportunity cost is always negative. Now, when I talked about opportunity cost, I gave an example of my own factory. So, I am going to do a project. I am going to put up my project in my own premises. This premises was being rented out to somebody. So, in that case, it's an opportunity cost. Now, what can be a side effect is? Assume I have some 10 lakhs worth of material with me. I have to use this material now. I think that there is a project which has come in wherein I can use this material. If I don't do this project, I have to dispose of that material. Normally what we have understood is material can be sold and you realize the scrap value. In this case what they are saying is if you don't use the material, they are toxic, and if you have to dispose it off, to dispose the material you will have to spend money. Rather than earning money, I have to spend some 2 lakhs rupees on disposing the material. So if I do the project, there is a 2 lakh saving. So the material cost for the project is minus 2 lakh because there is a saving of 2 lakh rupees. So that is called a side effect. So when you do a project, you may have certain side effect also. Future cash flow which is relevant, overheads you will have to ignore. I'll come to working capital. Whenever it is fixed cost, be very careful. Per unit is of no use to us. Always work with total fixed cost. We always work with total fixed cost. We never work with per unit fixed cost. I'll come to long-term fund principle in some time. I'll have a separate section on this. When it comes to reward exclusion principle, as of now you just understand that whoever provides money for a capital, whatever reward we pay to them, we have to ignore it. Whatever money we pay to them, we have to, whatever reward we pay to them, we have to ignore it. As such, FM is concerned, there are 3 people who provide money: debt, equity and preference. All these are partners in the business. What do you pay to a debt guy? Interest, as well as one more thing, principal repayment. Both of this will not impact my cash flow. So if you pay interest, interest will not come in my cash flow. Principal will also not come in my cash flow. No concept. Dividend, equity guys we pay dividend, dividend will not come in cash flows. Preference guys we pay preference dividend. So whatever reward we pay to the people who provide money will never come in the cash flows of the company. Clear? Now there is something called a shareholders principle, long-term funds principle. That alone I'll explain later. Consistency principle is very simple. Cash flow should be after tax, discount rate should also be after tax. Cash flows is before tax, discount rate should be before tax. Cash flows include inflation, discount rate should also include inflation. Cash flows exclude inflation, discount rate should. We did this when I did international capital budgeting. Money cash flows, real cash flows. So if there are money cash flows, use money discount rate. If there are real cash flows, use real discount rate. Step up discount rate is something which I explained in the last class. These are basic principles as of now. And these are steps in capital budgeting. Now whenever you do a project, there will be two types of cash flow. One is initial capital expenditure, second is working capital. Working capital is basically the money required for day-to-day functioning of the company. So that is also going to be my outflow. Any doubts in this? So I'll have an expense of capital budgeting, capital expenditure, 10 lakh rupees on machinery and 2 lakh rupees on stock, debtors and all. Every year I'll keep getting cash flow which I calculate as sales, all cost other than depreciation, PBDT less depreciation, PBT less tax, PAT add depreciation, CFAT. I said beyond this I'll explain what is going to happen. After getting CFAT, 2-3 things can happen in a company. One, you may buy another machinery in between. It is not necessary that machinery has to be purchased only on day 0. To do a project somewhere in between also I may buy a machinery. That can be an outflow. Second, when I buy a machinery, originally it is not necessary that I pay the entire amount. I pay only half of the amount. Balance half will be paid. That will also be written as an interim. See, initial capital expenditure is not the cost of the asset. It is what you pay. If cost is 5 lakh and you pay only 2 lakh, you will write only 2 lakh. Because you did not pay the money. Balance 3 lakhs will also be written, but will be written in year 1, year 2, year 3, depending on when you pay it. Clear? Any doubts in this? So my CFAT will get adjusted with 3 items. 2 items I've discussed. One, you may buy a new machinery. Second, what can happen is there can be something called as payment which is pending for my original machine. The third thing which is there can be an increase or decrease in working capital. Today you needed 2 lakhs worth of working capital. Then you may need 4 lakhs. Then extra 2 lakhs has to be written as an outflow. Then you may need 6 lakhs. Again outflow. Less inflow. We have done this when I did valuation of business. When we did free cash flow, if you remember after EPS, what you used to do is add capital expenditure per share, less capital expenditure per share, add depreciation per share, add working capital per share, and then we used to get free cash flow. The same is the thing we do here. Less purchase, less payment, add or less increase or decrease in working capital and you get revised CFAT. Now the last part is terminal flow. Whatever my original machine is there, I can sell it off and call it as NSV, net salvage value. I'll explain NSV in some time. And that is recapture of working capital. What is recapture of working capital is money which was blocked on day 0 will get released today. I'm not explaining in detail because some part of this has been done at IPCC level. Now what I will focus is on NSV part. So listen for some time on NSV. Net salvage value. So I'll explain the net salvage value part. Now I'm going to sell a machine for 50,000, 1 lakh, 1,50,000 and 0. These are the 4 options at which I can sell it. Now this is basically called a salvage value. The salvage value of the machines are these. So you are going to sell the machine for this. At the end of the project, there will be something called as book value. What is book value? Is original purchase price minus the depreciation which you provide for so many years. So the book value turns out to be 1,25,000. This is the book value which is there. Now you will compare these two and call it as capital gain or loss. in taxation you will learn block of assets method and all. Here I don't bring all of that. Capital gain or loss is basically just comparing the salvage value and book value. So my sale value is this, book value is this. 3 scenarios I have a loss, 1 scenario I have a profit. Now what you need to do is, for this there will be something called as tax paid slash saved. When you have loss, you will save tax. Why do you save tax? This loss will be offset against some other profit and ultimately my tax payment will come down. So whenever there is a loss, I am going to save tax. Let's assume the tax rate is 40%. So in one scenario I save 50,000 tax, 30,000 tax, 10,000 tax, and I pay 10,000 tax in the last scenario. My NSV is, I leave a line and write it because it's not a continuation. NSV is salvage value plus tax saved minus tax paid. See, book value is not a cash flow. Capital gain is also not a cash flow. One, you get a sale value which is a cash flow, and second, you may have to pay tax or you save tax. So NSV is sale value plus tax saved minus tax paid. So this is what is my net salvage value. 0 plus 50, 50 plus 30, 1 lakh plus 10, 1 lakh 50 minus 10. Why minus 10? Because I am paying tax. I am paying tax. So my net salvage value is this, and whereas the salvage value is this. So in capital budgeting, what you write is the net salvage value, not the salvage value. Wherever taxes are there, you will have to do this calculation. Clear? Able to understand this? So this is what is mentioned there. Sale value less book value, gain or loss, tax paid or tax saved, net salvage value, sale value plus tax saved minus tax paid. And obviously my step 4 is consolidating and calculating NPV. Clear? Any doubts on this? We're going to do few problems on this. We'll go through these steps. So basics is done. Go through question 1. So it's a practice problem. Let's do it in the class. Question 1. Okay, the requirement of the question is, should the project be accepted? We'll evaluate it through an NPV analysis. Step 1, initial outflow. Working note 1, initial outflow. Working note 1, initial outflow. Particulars and amount. Particulars and amount in bracket in lakhs. Particulars and amount in bracket in lakhs. First item is capital expenditure. Look at the question and see, is there any capital expenditure, any machinery data given? How much is the amount you are going to spend on day 0? Capital expenditure. How much is the capital expenditure? 120, no? Minus, which one? That is third year, so you cannot write it in year 0. Minus 120, capital expenditure is minus 120. That's a third year cash flow, so we will not write it here. Minus 120. Working capital. How much? Minus 15. Working capital minus 15. Total outflow. Capital expenditure 120, working capital 15, and total outflow is 135. $120, 15 and 135. Clear? Then working note 2, in between flows. Particulars in 8 years. Later on I'll tell you how can we club these things. Particulars and 8 columns. Year 1 till 8 columns you'll have to do. Later on I'll explain how can we do clubbing part here. Particulars in 8 years. Okay, now please listen. When I do working note 2, it's a flexible format which sometimes will start with sales, sometimes will start with PBDT, PBT. Is the information there in the question to calculate sales? Volume is given. So point number 1, units sold. Units sold. Let me know in terms of lakhs, okay? Units sold. That is capacity. What will be the units sold for year 1? 0.8. 80,000 is 0.8 lakhs. 1.2 lakhs. 4 lakhs is the capacity. I'm multiplying with 20%, 30%, 75% and 50%. Any doubts on the unit sold figure? Now next thing is, I know the selling price and what is profit volume ratio of 60% means my contribution is going to be 60% of the sales. Instead of capturing sales, I'm going to straight away capture contribution, because if I capture sales, then I have to write less variable cost. So straight away contribution. What is the contribution per unit according to the data? Contribution per unit is 60. How 60 is 100 rupees into 60%. So you multiply this with 60 and then proceed. straight away contribution. From this then we will deduct the other items. Less fixed cost. Now please listen, fixed cost is normally irrelevant, but in this question it is specific to this project. So when it is a specific to project, you will have to consider the fixed cost. How much is the fixed cost? 16 lakhs minus 16. Fixed cost minus 16. What's the number after fixed cost? Less, what else is there? Advertisement. Less advertisement. What other figure is there in the question? Advertisement. Any other expense there in the question? Once you deduct this, what do you get? PBDT, and then you'll have to deduct depreciation. So get PBDT. 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 Any doubts on this? Now go through the question and tell me what will be the depreciation. Depreciation. $16 point? No. What should be the depreciation figure? Okay.
Third year onwards, there's an additional reason at 10 lakhs. The salvage value of that for
Check it. So you will, I'll write it as two items. Depreciation of original machine. It's not necessary for you to write it as two items, and then you have depreciation of additional machine. This is more for your understanding. If in an exam problem, I'll write it together. 15 lakhs is what you will provide on the original machine every year. Additional machine, year 1 no depreciation, year 2 no depreciation, you buy it in year 3. 10 lakhs minus 1 lakh divided by 6 years of life. 10 lakhs minus 1 lakh divided by 6 years of life, which is 1.5 lakhs. It is 1.5 lakhs. 10 minus 1, which is 9 lakhs divided by 6. And then you will get PBT. This is the PBT figure. Any doubts on the PBT figure? Okay, now can we proceed? Now please listen. When I have profits, I pay taxes. The concept of capital budgeting says that when you have losses, you will save tax. And that tax saving is like an inflow of money. Now how this 13 lakhs will help the company is that again some other project where it is making profits, it will help them in saving taxes. And if you read the first line of the question, ABC Limited, an existing profit making company. So in short, this loss will help the company in saving taxes. So the problem can be of two types. One type, they will not give any information, that you consider tax saving. Second type, they'll say the loss of the first year has to be set off against the profits of the next 3 years, next 5 years, next 7 years. Now please listen. In both the methods, how we are going to work is less tax. What is the tax rate? So this is my tax outflow for all these years. When it comes to this year, please listen. It's a saving, 6.5 of inflow. 6.5 of inflow. This is one way of solving a problem, and my PAT will become, listen for some time. This will be my PAT. Another way of solving the problem is no payment, no saving. Next year, 26 lakh is the profit, but from a tax point of view, the taxable profit is only 13 lakhs, because 13 lakhs will get set off against this 26 lakh of profit. So from income tax point of view, the profit is not 26, the profit is only 13 lakhs, and on that profit in this year you will pay tax of 6.5. You will pay tax of 6.5. Balance years it's the same thing, 50% payment, because anyway you don't have any carry forward losses. So either you save tax in the same year. So in the first year itself you have a saving of 6.5, or second year you have a saving of 6.5 and you pay only 6.5. Clear? Any doubts in this? Complete this, add depreciation and get CFT. Any doubts on the CFAT figure? Beyond CFAT, 3 adjustments. Payment for original machine was fully done. There is a purchase of additional machine which I have to write. And the other thing which will be there is increase or decrease in working capital. Of these 3, in this question, there is one item which is there. What is that? Less purchase of additional machine. Please capture that. And revised CFAT. Less purchase of additional machine. Purchase of additional machine. Which year have you purchased the additional machine? Third year. Where will you write it? It says beginning of third year. Finance as a concept says all cash flows will happen at the end of the year. So what will happen is beginning of third year is not third year, it's end of year 2. So my purchase of additional machine will come here. This is one adjustment which is there in this question. Purchase of additional machine is going to come in year 2, and that's what I have given us a note below. So purchase of additional machine will come in year 2 rather than year 3. Because this cash flow which we are seeing is technically a year 2 cash flow rather than a year 3 cash flow. Clear? That is why in fact we are able to charge depreciation in the third year. Why we are charging depreciation in the third year is we are buying the machine at the end of year 2, not at the beginning of year 3. Get the revised CFAT and then we go to the next part. Beginning of year 3 is end of year 2. Now, as you practice more problem, you will understand when the columns have to be clubbed. In this question, I would have created only 4 columns. Year 1, year 2, 3 to 5 together, 6 to 8 together. Because everything is the same thing written over there. We don't change any of the stuff. So, year 3 to 5 would have been one column and year 6 to 8 would have been another column. There's no point in keeping it as separate columns. We would have clubbed it and done together. Next, working note 3, terminal flow. Any doubts on the revised CFAT figure? Can you proceed? Working note 3, terminal flow. Terminal flow. Now, terminal flow is going to have 2 things. One is net salvage value and the second is recapture of working capital. Particulars and amount. Net salvage value, recapture of working capital. Net salvage value and recapture of working capital. Net salvage value in bracket note 1. Okay, now listen. Please listen. I'm going to take you through the net salvage value calculation. Note 1 is this: particulars, original machine, and additional machine. There are two machines. Please listen for some time. Sale value, book value, capital gain slash capital loss, tax paid slash saved, leave a line, and NSV. Original machine will be sold at what price after the project? 0. Additional machine? 1 lakh. Now please listen, book value, see, sale value of 0 doesn't mean you need not calculate this. You will have to do a small check. My book value is, originally I bought it for 120 lakhs. Every year I have been charging depreciation. After 8 years depreciation, what will be the book value of this asset? 0, because we have charged 15 lakhs. Some problem, instead of charging 15, you will charge 12 lakhs. The question will tell you do it that way. If that is the case, then you will have a book value. If there is a book value, there will be a loss. If there is a loss, there is a tax saving. So instead of 0, if this was 30, just an imaginary scenario, this would have become 30 of loss, and you will save tax on this. So my tax saving is, what is the tax rate? 50%. So this would have been tax saving, and my net salvage value would have been 0 plus 15. It would have been 0 plus 15. The NSV would have been 0 plus 15. Clear? Despite having a 0 salvage value, you will have an NSV of 15. In this case, it is 0 anyway. Doesn't matter. What will be the book value of additional machine? It will be 110 minus 1.5 lakh for 6 years. So this is going to be 1, no capital gain, no this, and NSV is 1. Now I would not be doing this check. Now please listen. Before doing this working note, I'll always do one thing called as, is the sale value and book value same? If it is same, net salvage value is equal to sale value. If the sale value and book value is same, no concept of gain, no concept of loss. But if it is different, then obviously you'll have to do the calculation. If it is same, you just copy paste. Clear? So in this case, I need not do this working note, but here we are doing it. So anyway, you can copy this in some time. So my net salvage value is 1. Recapture is whatever was initial outflow is now an inflow. So 15 lakhs money blocked on day 0. 15 lakhs is the money released on year 8, and terminal flow is 16. Total terminal flow is 16. Please do this. Now you will have to consolidate these cash flows and calculate NPV. Consolidate the cash flows and calculate NPV. Consolidate and calculate NPV. You can copy the cash flows from working note 1 to working note 3 and then calculate NPV. Cash flows will be available from first working note till the 8th working note. Calculate from that and then write it. Yeah, you look at revised CFT. That is the cash flows. No? Your cash flows are basically the revised CFAT. So, initial outflow will come from step 1, 1 to 8 will come from step 2. Eighth year, be careful, it has to be step 2 plus step 3. Last year, the figure will come from step 2 as well as step 3. Any doubts on this? The final NPV is positive. We'll go ahead with the project. Positive, go ahead. Negative, we don't do it. Can you proceed? Any doubts on this? Go through question number 2. Please read question number 2. Okay. Now, there are a lot of things which you are going to learn here. The first concept which you are going to learn in this question is something called as uniform cash flow. Now, last problem when I said the machinery was purchased at the beginning of year 3, where I told it is end of year 2. So, finance as a concept has always worked on end of the year concept. So, it says all cash flows will happen at the end of the year, but practically it's impossible to say that my revenues will come only on the last day. It will be uniformly throughout the year. So if it's going to be uniformly throughout the year, then there's something called as uniform cash flow discount factor rather than a end of year discount factor. If you see present value of rupee 1 at 25% discount rate, year 1 at the end of the year means it is 0.8. If the same 1 rupee is received throughout the year, the worth is 0.88 rather than 0.8, because just not receiving on a single day, I received first month, second month. Now how this 0.88 has been calculated, you understand and then note it down there. My 25% is the discount rate, so my monthly discount rate is this 2%. Technically 25% is for a year, the discount rate for a month is 2%. Now please listen, 1 divided by 1.020833, 1 divided by 1.020833 equal to is this factor, first month factor, second month factor again equal to, third month factor, fourth month factor, it goes on like this. 1 divided by 1.0208, if you put a equal to, you will get this number, Again I equal to, you will get this number. Again I equal to, it goes on like this. Any doubts in this? This, yeah. No, uniformly throughout the month, no. Uniformly throughout the year. The cash flows are going to be received uniformly throughout the year. So every month you are going to receive something. I cannot go to everyday level, so I am taking every month. Instead of going to everyday level, I am going to every month. So once I get this number, this is my 12 months ka factor. If I take an average of this, that average is 0.8767. That average is 0.8767, and that is what is given in the question, 0.88. You cannot do calculation saying that month 1, if I do like that, then I'll have to open some 48 columns. If it's a 4-year project, 3-year project, 36 columns have to be opened. So I don't want to do all of that. I'm going to club it as year only. I'm going to do calculation as year only. The discount factor, instead of using the year-end discount factor, you use the uniform discount factor. So in the in that side, you can write how that uniform factor has come. Average of 12-month discount factor. Average of 12-month discount factor. Average of 12-month discount factor, and month 1 discount factor equal to 1 divided by 1 plus monthly discount rate. Month 1 discount factor equal to 1 divided by 1 plus monthly discount rate. 1 plus monthly discount rate. Month 2 is month 1 divided by 1 plus monthly discount rate. It goes on like that. Like you had a yearly discount rate, you have a monthly discount rate. Any doubts on this concept? Now we will first calculate the cash flows in a normal manner, ignoring all of this what I've talked about. Let's ignore all of this. We will calculate the cash flows in a normal manner, and then I'll make certain adjustments to the cash flows. There are going to be certain adjustments which are going to be made, so I'll explain that adjustment as we do it. Working note 1, initial outflow. Initial outflow, particulars and amount. I'll come to this uniform part and all in some time. What is to be done with that? First is research and development, 75,000. I'm asking you, I'm not sure. Research and development, relevant, irrelevant? Sunk cost, zero. Sunk cost, zero. Machinery cost, machinery, how much? 9,60,000. Anything else? There is this new machinery will be installed in a factory area. The company has already arranged. This payment has to happen now. What do I do with that? Removal. How much? Relevant, irrelevant? Read that line. It's already arranged, it's irrelevant. If it was to be arranged, then it is relevant. I'm not sure why they arranged this, but it's already arranged, so it is irrelevant. So removal cost of old machine. It is not sunk cost, but it's called as committed cost. You've already committed to doing this, so you can't do much about it. All committed costs are also irrelevant. Clear? This will be my initial outflow. This has to be minus 960. Sorry. If this was not arranged, then it would have become a relevant item for us to write here. Clear? Can we proceed? Anything else do you think will come? There's one more thing which has to come. No, that's rent. That's a regular rent. If at all I'm writing, it's a regular rent. Advertisement of the new product will be this. Assume advertisement to be incurred at the beginning of the year. So the moment I start the project, I'll incur advertisement cost. Advertisement cost is going to be incurred the moment I start the project. Beginning of year 1 means year 0. Beginning of year 1 is year 0. What are we going to do on the tax side? I'll explain in some time. Beginning of year 1 is year 0. So advertisement cost is how much? 1,25,000. There is going to be tax impact on this that I'll explain as I proceed. As of now, write this. It will come there also. As of now, I am writing what is relevant for year 0. Because beginning of year 1 has to come in year 0. It will obviously come in the in between cash flows also. But this is written here because this is beginning of year 1. Clear? Can I proceed? Working note 2, in between flows. Particulars in 3 years. Start with sales. Particulars in 3 years. Start with sales. Sales is 15 lakhs. 25 lakhs. Then less. What is the variable cost percent? Take it directly contribution. Contribution 40%. Contribution 40%. So point 1 is given effect, point 2 is given effect, point 3 is given effect, variable cost. What do you do with 10,000 fixed cost? It will be increased by 10,000. Increase means it's a relevant item. So there could be 5 lakhs already spent. Now another 10,000 is getting spent. So that is relevant. Less fixed cost. Less fixed cost. 10,000. It is relevant item because it's incremental in nature, additional. Less fixed cost. Now I'll come to advertising. Now please listen. What is the first year advertising as given in the question? Now I'm going to write 1,25,000. This is because to calculate tax properly, and then I'll have to do adjustment after my P&L is done. So for the purpose of tax calculation, I'm left with no option. I'll have to write depreciation. Advertisement is 1,25,000, 75,000, 60,000, because from a tax point of view, this is the expense of that year. There are different schools of thought also. Some authors say that why do you want to take it in year 1, take it as in year 0 itself, because in India you have a lot of advance tax provision, which means whenever you are spending something, immediately you get the benefit out of it, because you pay lower advance tax, higher advance tax. But institute in most of the times they do not agree to this, and they kept on doing which year, there only it is written. So advertisement is written here. I'm going to do an adjustment on advertisement in some time. So less advertisement. Okay, now please listen. I'm going to write depreciation also. I don't want to separately capture PBDT because it doesn't serve any purpose in my cash flow. I can directly go to PBT itself. There are certain other items we'll come to in some time. Calculate depreciation, write depreciation. After depreciation also we'll have some more items to be deducted. I don't want to capture PBDT. WDV method. 1/3. Salvage value doesn't come under WDV calculation. Okay, listen for a minute. Whenever you want to do WDV, the easier way of doing it, 9,60,000 into 1/3. That's the first year depreciation. Into 1/3 is 33.33%. I've converted as 1/3. Listen for a minute. 9,60,000 into 1/3 is depreciation is this. Next year onwards, don't try to calculate what is the WDV. 1/3. Next year depreciation will be 2/3 of first year. Next year again 2/3 of the second year. Next year again 2/3 of the year. So if I want depreciation for future years, I can keep doing this. 2/3, 2/3, 2/3, 2/3. It goes on like that. So your depreciation will always move like that in WDV method. So no need to create a schedule and all. First year 1/3 of the original cost. Second year onwards 2/3 of the first year cost. If first year is 1/5, second year is 4/5 of the first year depreciation. Your depreciation will keep coming down by 1/3 in short. So that's why I say 2/3. So this is the depreciation figure. First year is 1/3 of the cost. Second year is 2/3 of the first year depreciation. What to do with that rent information? Go through it and let me know. Relevant, irrelevant, you want me to write something, not to write? Company? I gave an example. No, owned warehouse doesn't mean it is irrelevant. No. Notional rent. You need not pay any rent, but the concept is finance opportunity cost. No. How much? No. See, I have a warehouse which I've been trying to rent it at 25,000 per year. If I could rent it at 25,000 per year, opportunity cost is 25,000. If I could rent it for 25,000, it is 25,000 hour. Because by using it for my project, I lose the 25,000. But they are saying several offers have been rejected. The highest being what? 15,000. So when I start this project, I lose the opportunity of that 15,000. So my opportunity cost is 15,000. It's not 25 minus 15. So less rent in bracket opportunity cost. I lose the opportunity of earning that 15,000. less rent opportunity cost 15,000. Any doubts on this? Get PBT, less depreciation, less tax, PAT, add back depreciation, CFT, do all of that. Get the CFAT and then I'll tell you few more adjustments which are to be done. If you're done with CFAT, let me know. I'll explain the balance part. Can you proceed? Okay, now please listen. Listen for some time. Add back advertisement, because I said advertisement was just captured for calculating tax. So CF after I'm adding. Listen for some time. Listen for some. You've got till CF80 figure. Add back advertisement. Uniform cash flow. Year-end cash flow. Now, what is this year-end cash flow? I'll explain. Wait. Beginning of year 2, how much is the advertisement? Beginning of year 2, 75,000. Now, advertisement was 125, 75 and 60. 125 went to year 0. 75 has come to year 1. 60,000 has come to year 2. Now I am going to distinguish two type of cash flow. One which happens uniformly throughout the year, because if it happens uniformly throughout the year, the discount factor for that is 0.88. If it happens at the end of the year, the discount factor for that is 0.8. If something is uniform throughout the year, for year 2 it is 0.69. If it's at the end of the year, then it is 0.64. So we are going to distinguish between uniform cash flows and normal cash flows. Clear? Any doubts till now? Any doubts? So uniform cash flow says 0.88, end of year says 0.8. So 0.88 is what I will take if it's uniformly throughout the year, and if it's at the end of the year, we will take only 0.8. Clear? Able to understand till now? Now, sales is something which is going to be uniform throughout the year. Contribution uniform throughout the year. Fixed cost uniform throughout the year. Advertisement is not uniform throughout the year, and anyway I am doing an adjustment to it. Rent is uniform throughout the year, and tax is also uniform throughout the year. So after adding back depreciation, whatever we get is the uniform cash flow throughout the year. This will be multiplied with 0.88, 0.69, whatever those numbers you see. Advertisement is a one-time cash flow. So this will be multiplied with the other factor 0.80, 0.64 and 0.51. So I am segregating the cash flows into two. First I added back the depreciation. Ideally I should have deducted the depreciation of added back the advertisement, and I should have deducted the advertisement which is relevant. Instead of deducting, I am just showing it here. Added back advertisement of year 1, and I should have reduced advertisement of year 2, because that happens in year 1. Instead of deducting it, I am leaving it as it is, because this is going to happen, this will be taken as year-end cash flow, and the discount factor for this is going to be different, and the discount factor for the earlier one is different. Able to understand the difference? Clear? Do this and leave it, and then do step 3. Then do step 3, which is terminal flow. You don't write anything, that's all. These are two different type of cash flow which can't be added. So what we do with this, I'll explain later. You do the terminal flow calculation, sale value less book value, all of that, do it. Do the terminal flow calculation then. Sorry, terminal particulars, how much? Who will do the calculation? Net salvage value, sale value less book value. Do that and let me know. Book value is nothing but 9,60,000 minus the 3-year depreciation. In short, the WDV value at the end of third year. 9,60,000 minus the depreciation which you have charged for 3 years. Any doubts on this? Now I'll take you through the NPV calculation. Any doubts on the terminal flow? Now please listen. Here cash flow. Normally cash flow used to be one column. This question it will be two column. Uniform year end. It will be uniform and year end. Whatever. Because there are two types of cash flows. No, you have uniform cash flow, you have year end cash flow, and the discount rate is different for the two. Uniform means it is 0.88, year end means it is 0.8. So year cash flow uniform year end, PVF uniform and year end, DCF uniform and year end. Let me just complete this. Year 0, year 1, year 2, year 3. Year 0 there can't be anything like a uniform number because that's only at the beginning of the year. Year end number for year 0 is, year 0 is 10,85,000, only one time expense which happens. Year 1 uniformly I earn 5,10,000 and year end I pay this advertisement of 75,000. Advertisement of 75,000. Uniform is 5,10,000 and year end is 75,000. Year 2 uniform is 6,31,667 and year end is 60,000. Year 3 uniform is 2,08,611 and year end is NSV of 1,92,222. All see this year end figures are one time item that will happen only on a single day. Those are year end items. For example, 75 happens in a single day, 60 happens on a single day, 192 happens on a single day. So anything which happens on a single day is going to come as a year end item. Anything which can happen throughout the year, that is sales, variable cost, contribution, advertisement, not advertisement, all other taxes, everything happen throughout the year. So these cash flows, till now what you used to do is these used to be added, this used to be added, this used to be added. Here you will have to distinguish them. Here you will have to distinguish them. Uniform means one I am writing. 5,10,000, what is the discount factor for uniform? 0.88 and year end is 0.80. This is 0.69 and this is 0.64, 0.51 and 0.54. You do the multiplication and then get to the answer. Which one? Which CFAT? That is of no use, no. You'll have to adjust that CFAT, no. That's where you get uniform CFAT. Advertisement is to be adjusted with that, no. We had deducted advertisement while calculating 385. That is a wrong thing to do, but I had to do it to calculate tax. And now I am recovering, adding it back. Practically cash flows can't be one day, it is normally uniform. So from a practical point of view, this is what will ideally happen. final NPV is adding that uniform and year end, it will be negative. So we will not do the project. Finally, it is going to turn out to be a negative NPV. Net NPV is 997,300 minus 1085. Can you proceed? Any doubts in this? It's a good problem to understand the cash flow calculation part. Go through question 3. Can we start? So they have given details about some amusement park to be set up. It is going to generate some revenue, some cost structure is given. The initial investment is given, depreciation information is there, and finally net they want us to calculate should the company proceed with the project. Working note 1 initial outflow. Working note 1 initial outflow. We'll do this problem in lakhs. They have given in millions. Let's do it in lakhs. Initial outflow. Particulars and amount. Particulars and amount. What are the initial investments? So first one is equipment, building. Equipment is there, building is there. How much is the equipment? 1000 lakhs. We'll do it in lakhs. 1000. Building is also 1000. And working capital is? See, cash is also blocked only. That is money which is blocked. So that is also like a. Which one? No, I didn't understand. Initial outflow first. It will come in initial outflow, then it will come in terminal inflow. So today it's an outflow. After 4 years, it's an inflow. So total outflow, can we proceed? So we'll come to that in some time. As of now, it's initial outflow. Any doubts on the initial outflow? One more item which could have come in initial outflow is land. Okay, but the last line of the question says the firm uses vacant land for the new attraction and it has no alternative use of land. So when there is no use of the land, I'm just using the land, so I'll not pay anything for that. We are just using a land which has no use, so I don't have any cost associated with it, because when I'm constructing an amusement park, obviously land is also one of the expense, but the question has made it very clear saying that there is no alternative use of the land, so I'm using a vacant land. Now I'll take you through in between flows. You listen for some time and then write it. Particulars and how many years? I'll have to do it separately because depreciation is going to be different for different years. Otherwise, we could have clubbed it. Year 1, 2, 3, 4. What is the revenue? Revenues is? Where is it? Okay, yeah, 400 million. So 4,000 lakhs. Listen for some time. I don't want you to write anything. Listen for some time. Revenues is 4,000 lakhs. What is the cost? Variable cost. How much is the variable cost? First paragraph. 50% of the cost. Let me write this and then I'll explain the concept around it. If of that 60% is paid and 40% is in credit, I'm not going to do anything with that as of now. I will do all this adjustment after CFAT. Why I don't do before CFAT is my tax will then take a hit. Whether I pay my expenses or I don't pay my expenses, tax authorities will give me benefit. Because if I have not paid, it will look like a creditor in my books of accounts. So be it creditor in my P&L. So my P&L will have a revenue credit of 4,000 and debit of 2,000. Whether I have paid or not paid does not matter. So I'll come to that in some time. What are we going to do for the payment which has not happened? So para 1 is almost utilized. I don't need anything else in paragraph 1. Paragraph 2 is about depreciation. We'll capture the depreciation in some time. In paragraph 3, do I have anything else to be captured? Paragraph 3, after tax cash inflow from other amusement parks will decline by 20 million. What do I do with this? What do you understand by this? 20 million will come down. So it's an opportunity cost, but I'll write this opportunity cost after calculating CFAT, because what they have mentioned is the after tax cash inflow from other amusement parks comes down, not a normal cash flow. If it was normal cash flow coming down, then this would have become less opportunity cost at this stage. Okay, so so I will calculate CFAT here. I said incremental principle, MBA 13 lakhs, CA 9 lakhs, so incrementally 4 lakhs, so that is relevant. So what this project earns, if this project gives me 40 million, what is relevant is only 20 million, because 20 million anyway was coming. So I'll come to that in some time. Any other information there? What to do with that R&D? That is irrelevant. It would have come in step 1 itself. It's already paid, it's irrelevant. Value of equipment and all is given, so straight away now we go to depreciation. Less depreciation. I'll do it as 2 items. First I'll do equipment. Equipment they have said 33.33%. So my equipment value was 1000 into 33.33%. second year is 1000 into 44.45%. These are not WDV, these are, I assume, SLM depreciation. Third year into 14.81%, and last year net I think it will get fully depreciated. That's how the data should have been given. Yeah, net entire 1000 is depreciated. Net entire 1000 is depreciated. Then on building, 1000 into first year is 3.042%. I'll follow whatever percentage they have given in the question. 3.042%. Next year is 3.175%. 31.75. Why it is only this percentage? Because it has a life of some 31.5 years. What are we going to do with residual value and all? I'll come sometime. Any doubts on the depreciation figure? We get PBT less tax. What is the tax rate? 34%. This is my tax figure. PAT. Now assume if in an exam you are in an urgency to close a question, don't write tax, straight away write PAT is 66% of PBT. PAT is 66% of PBT. Hardly serves any purpose, but as a presentation people keep writing it. In case I am in an urgency mode, I will directly write PAT as 66% of PBT. Any doubts till now? Add depreciation. PAT, and I am adding back depreciation, and this is, sorry, okay, add depreciation is this figure, and CFAT is this much. Any doubts on the CFAT? Now I'll explain that part. I'm preparing a balance sheet on day 0. I'm focusing only on current asset and current liability. Okay, so on day 0, current asset, current liability, year 0, 1, 2, 3, 4, 5. Let me keep it at 5 years. Year 0, my current asset is 10 lakh of 100 lakh of cash. Current liability is nothing. Current liability is nothing. My working capital is, okay, they have not mentioned anything about cash, so I assume cash continues to be 100. My current liability is, at the end of year 1 I didn't pay some expenses. I need to pay some expenses. So whatever expenses I have not paid will get reflected as current liability. So the question says 60% of this is paid in cash and 40% is paid in credit. So 40% will be paid only in the next year. So at the end of year 1 you will see a current liability which is 40% of this number. You will see a current liability which is 40% of this number. Next year again a current liability of 40%, next year again a current liability of 40%, next year again a current liability of 40%, and at the end it will get closed. Any doubts on the current liability figure? Then I'll directly do the adjustment, but if you have understood this concept, and my working capital is going to be at the end of 4th year this will become 0. The cash will get released from the system and my working capital will become 0. My current assets will become 0. Now please listen, how we are going to give effect to this adjustment is, in year 1 there is going to be something called as increase in working capital. In year 1 there is something going to be, decrease in working capital. My working capital comes down. Why does it come down? Because I get creditor funding. So listen for some time. I am writing another year called as year 5. Add increase in working capital. You don't want to learn it as increase in working capital. You can learn that out of that 2000, 800 is not paid. So this is a extra inflow for us. We did not pay 40%. 800 is extra inflow, and my total CFAT is, I'll explain again, wait for a minute. Second year, what is going to happen is I will pay this 800 and another 800 will become a liability. So net net, no increase in working capital, no decrease in working capital. So year 2 moves like that, year 3 moves like that, year 4 moves like that, and last year I pay this 800. I pay this 800. So either I can show it as working capital adjustment. If I don't want to do it as working capital adjustment, now please listen. Add non-payment of variable cost, non-payment of variable cost less payment of previous year variable cost, payment of previous year variable cost. In the first year I did not pay 800 lakhs of variable cost, so that is adding back, because I deducted when I calculated here. Why I deducted? To calculate tax, to calculate tax. Like we add back depreciation, I'm adding back variable cost. So I did that. Nothing of previous year got paid. Again I added back 800, but I'm paying previous year 800 now. Again I'm paying previous year. So technically what you are doing is you are adding back 800 800 800 800 and paying that 800 800 800 in the next year. Clear? Adding back 800 in year 1, year 2, year 3, year 4, and paying that in year 2, year 3, year 4 and year 5. Paying that in year 2, year 3 and year 4 and year 5, and my final net cash flow is, forget about that cash adjustment as of now, that will be a little confusing for you to understand. So the project will give 2243 lakhs in year 1, 1481 lakhs in year 2, 1381 lakhs in year 3, 1355 lakhs in year 4, and will have an outflow of 800 lakhs in year 5, because I did not pay it. I did not pay it. Clear? Able to understand this? This adjustment I cannot do at this stage. If I do at this stage, tax will become a problem. If I do at that stage, tax will become a problem. So I prepare my normal P&L. In a normal P&L, we add back depreciation. I've added depreciation. We add back non-payment of cost. I've added back, and I've subtracted payment of variable cost. Clear? Any doubts in this? Any doubts in this? Then I'll take you to the terminal flow in some time. Complete this. So ignore that. That will be confusing at this point of time. Ignore the current asset, current liability part. As of now, just understand it like this. I'll explain current asset and current liability in some other problem. Here it will become a little confusing. So you did not pay, no? 800. 40% is not paid. 40% of variable cost is not paid. 60% is paid, 40% is not paid. So not paid is written here. Again not paid, not paid, not paid. But this not paid has to be paid here. Not paid has to be paid in the next year. So the project is not a 4-year project, it goes to the 5th year. Any doubts in this? Do the terminal flow calculation, three things: equipment, building, and recapture of working capital. You will have to consider the sale value less book value, all of that has to be done. This project is not a 4-year project, it's a 5-year project from a cash flow point of view. Calculate the terminal flow. Whatever is your initial working capital blocked, that will get released at the end of 3rd year. Oh, sorry, at the end of 4th year. $110 million. Your book value of building is 1000 lakhs, which is our initial investment, minus whatever depreciation you have charged, and you're going to sell it for 110 million. Consolidate all of this and calculate NPV. Sorry, we have not done one adjustment. We had to do that 20 million adjustment. I missed it. There was an after tax. So ideally I should do it at this stage. Even I do it here also, it is fine. Less opportunity cost and net CFAT. I'll have to do this after the CFAT is calculated. So less opportunity cost. How much? 20, 20, 20 or 25? Okay, 20. 20. So minus 200 for the 4 years. And my net CFAT is this. Yeah, fifth year only negative. Only negative is there. The other logic could be is that once the project is over, I will be forced to pay that 800 also. So in the fifth year itself, my outflow could have been 1600 also. So that is a logic can be taken. Institute has done it this way, so I'm proceeding with the same way. Which one? You're not getting it. Wait, what happened? 1100, book value is 8674. Sale value minus tax paid. I told you it's not continuation. Sale value of 1100 minus tax paid. This format is not a continuation. A lot of people take it as a continuation and write 225 minus 76. Your NSV is sale value minus tax paid. Sale value minus tax paid. Calculate the cash flows and then verify here. Let me know in case there's a doubt anywhere.